Hey everybody, it's great to be back in front of the camera. I know we were off for a couple of months. The individual, Nathan, who takes care of all of our filming and editing, he graduated from college this year and was able to take a time off and visit Europe. And so we're glad that he was able to get that accomplishment out of his way in life. And at the same time, great to be back. He's opened up his studio today so that we can film a new video. And I know it really comes at a critical time. Markets have been really volatile lately, and I know it's got everybody's nerves on edge. So we really wanted to go over three key points. One being, what has the Fed been doing? Where does inflation sit at the moment? And what does this mean for the market? If you look at what has the Fed been doing, I know the big topic is they're raising interest rates, which that is correct. They've been raising short-term interest rates 5 consecutive times so far this year. But there's a little more to the story than that. The other thing that is happening is that the Federal Reserve, back during the pandemic, bought a lot of bonds, basically making their balance sheet a lot larger and also putting a lot more cash into the system. Well, what has happened over the last few months is they're selling these bonds back into the market, which basically takes cash out of the market and drives long-term interest rates higher. So it's been kind of a double whammy that they're increasing short-term interest rates while simultaneously selling off bonds into the market, driving long-term interest rates up higher. I don't necessarily agree with what they're doing. I think they were behind the 8 ball on raising rates, that inflation's been around for a while and they should have acted sooner. But at the same time, I think now they're trying to counteract what they did, and I think they're being just a little too aggressive. That is actually starting to show up a little bit in some of their comments. I think they realize the same thing. So it will be very interesting to see if they don't slow their pace, or maybe that they don't pivot to a little less aggressive interest rate increase and movement over the next few months. We actually think that interest rates will stop going higher probably by the end of this year. That being said, if you look at where we currently see inflation, really, inflation peaked around June. The June CPI was the highest number, and since then it has been moving lower. If you look at copper, if you look at steel, if you look at oil, you can look at lumber. Lumber is actually at a almost all-time low at this point in time. So things that were very expensive in the first half of the year have been coming down in price. Obviously, that's not inflation, that's more deflation. The one area that we have not seen the retraction yet is in the labor market. We do believe that that's coming through LifeSteps retirement services. We've already started to see a number of companies begin layoffs, and people start to roll their 401ks into IRA accounts. So we don't think that it will be too long and you really start to see a softening in the labor market, and this will start to make the Federal Reserve move into a little softer stance, or often referred to as a little dovish stance. The last thing is, what does this mean for the market? Obviously, we've seen a lot of pain in the market. This has been the third longest downturn in the recent history, but it has definitely not been the deepest downturn. We've been down just over 20% now, which is actually a bear market, pretty average, pretty normal. We don't think that it will go more than 28, maybe 30% at the max, and it may not even get that close. However, we are keeping an eye on what's taking place and making sure that the market kind of doesn't get out of control, especially when we're looking at bond markets and currency markets. Those have definitely been much more of an upheaval than the stock market. Once they settle down, which we believe will be in the next 3 to 4 weeks, we think the stock market will come around. And once it does, there'll probably be a big rally up. And that's why timing the market becomes very difficult. You never know. Somebody comes out with a headline, the Federal Reserve makes a change, one key indicator shows that inflation is done, and the market will rip itself up 2,000 points in a matter of a couple of days. If you're out of the market, you'll miss those gains. And so that's one of the reasons why we don't try to time the market, but we try to position ourselves for the long term. And that being said, this has given us a great opportunity to really look forward over the next 2 to 3 years and have a much more balanced and a much more rounded position in our portfolios. For the last 8 years, there's been virtually no way to use bonds in a portfolio because interest rates have been so low. Well, now that interest rates are much higher, we're able to go in and provide much more stability through bonds and capture a lot better interest rate on those bonds going forward. So over the next quarter and a half, we'll be repositioning portfolios, adding more fixed income or bonds to the portfolio, and really getting back to something that's much more normal, something that we would have saw 8, 9, 10 years ago, as opposed to the last 4 or 5 years where we were much more equity driven. I know this is not necessarily the easiest thing for people to go through, but it's not out of the ordinary. This isn't something that's completely off the charts. It's kind of a normal correction. Once again, we can't time them. We'd love to be able to do that, but it's just not something that's possible. The best way to get through them is to simply position ourselves and look for the future. I know that 2023 will become a recovery year, and we're looking forward to that taking place. If you ever have any questions or concerns, please don't hesitate to call the office, and we look forward to more videos. And if you're not receiving our newsletter, please let us know. That should be in your email box once every month. Thank you.